Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Tuesday, the 11th of February. I'm Daniel Lam, your host for the podcast. Over the last 2 weeks, DeepSeek has really dominated conversations, both internally with our colleagues and also externally with clients. Now, one of the more encouraging signs that I've noticed, being physically in Hong Kong, is the less pessimistic sentiment towards Hong Kong-China equities. Now, from a global perspective, Chinese technology companies linked to the development of AI will likely benefit. We've seen some rotation into Chinese equities since the end of January because DeepSeek is a positive surprise. It has narrowed the discount of Chinese equities versus global equities, and therefore this will push up the floor of the Hang Seng Index, and we roughly estimate that to be the 20,000 level. Of course, we're still wary of the trade war being a key macro risk, so therefore we continue to recommend a core allocation into China within our neutral stance in Asia ex-Japan equities, advocating a barbell approach of positioning into high dividend, non-financial state-owned enterprises and the Hang Seng Technology Index. Now, globally speaking, the emergence of this cheap cost alternative to OpenAI will lead to companies emphasizing upon the efficiency of AI investments, i.e. they will be demanding more bang for the buck for their investments. Hyperscalers, which are the large cloud service providers, are likely to remain aggressive with AI spend. Although the mix may change, they will likely require more efficient chips and greater computing power as they accelerate AI adoption and the development of high-end areas, for example, agentic and physical AI. Now, history tells us that cheap cost alternative is going to make the industry even bigger. And we believe this is going to increase the size of the pie in the AI industry, which is positive for the long term. And therefore, our stance to buy on dips in the broader US technology and communication services sectors. However, in the near term, there's likely to be volatility ahead still in specific industries or stocks. So therefore, within the technology sector, investors should use the scaling in approach to areas such as semiconductors and related equipment where we are expecting valuation multiples to compress. We also expect rotation within the technology sector. So for example, software companies will likely benefit due to the Trump effect, for example, no tariff headwind, increasing M&A, and AI monetization. Large software as a service providers with access to customer data will benefit from the emergence of low-cost solutions such as DeepSeek. That is all from me for today. As always, if you enjoy these podcasts, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.